Good evening and welcome to the latest Value the Markets shareholder webinar. This evening we're joined by Hayden Locke, CEO of Emmerson PLC. Emmerson is currently pursuing the world-class Khemisset POTASH project in Morocco, and last week released its definitive feasibility study, which gave a comprehensive review of the project's potential and its economics. This evening, Hayden will be giving us a presentation to go through the project and the latest findings, and we've also received a number of questions from shareholders in advance. This is a live broadcast, so please do feel free to ask us questions as we're going through all of this, and I'll be putting those to Hayden at the end of the presentation. So Hayden, welcome this evening, and over to you.
Thanks very much, Ben. Great to be here in this new format for me, so I'm quite excited. I think we'll start off with a very short presentation, and then we might as well jump straight into the Q&A that's been sent in from all our shareholders. So if we skip through until we get to the slide showing the map, please, which is the third slide in. We're developing the Khemisset POTASH project, which is located in northern Morocco. As you see here, the project is in an absolutely outstanding location, and location and low capex are two of the big themes that will come through in all of our presentations and have done since we started this process of analysing the potential of these very exciting potash projects. Located in northern Morocco, about 60 to 70 kilometres inland from the capital city of Rabat, in between two major capital cities in Rabat and Fez. What's really important about this location is, number one, we have amazing access to infrastructure. You see there's rail lines, there's power lines, there's roads. And the second point is you'll see on the coast there numerous port options that we have for the eventual export of our project. So an absolutely top-notch location, and that really plays through in why this project is so successful on the economic bottom line. You go to the next slide, please. So a high-level summary of the project itself. We have a very large JORC-compliant resource of a bit over 500 million tonnes, which really puts this project in a very long-lived category. So the feasibility study that we just put out has a 19-year mine life, but that's based on only 43% of that total 537 million tonnes. So all else being equal, we would expect to be able to increase that mine life quite significantly. An outstanding location, as we've already touched on, with brilliant access to markets, brilliant access to infrastructure. We've just completed the feasibility study, which is a huge de-risking milestone for any company looking at developing a mining project. It is absolutely it's a low capital costs and high margin potash project. Sorry, I think I just had my BBC moment with my son coming into the room. And a proven board and management team who have a lot of experience in developing these mining projects in Africa. A couple of the headline numbers: we have a post-tax NPV8 of $1.4 billion with an IRR of 38.5%. That is absolutely exceptional, and you'd be very hard-pressed to find many long-lived projects with those sorts of numbers attaching to them. One of the things we were really, really happy about was a reduction in the pre-production capital cost number for the potash mine. Came down from a bit over 400 million to a bit under $400 million. That's very rare as you move to the higher level of engineering and all the estimates that go into the feasibility study. Typically you see a lot of movement the other way. We're also very happy with the metallurgical recoveries, which are based now on that detailed metallurgical test work program that we completed last year, have improved over the life of the mine to about 85%. And that really drives us seeing those amazing economics that we put out in the feasibility study, where we have EBITDA margins over 60%, post-tax cash margins of approaching 50%. Very robust cash generation, EBITDA over the life of the mine of over $300 million per annum. If we could go to the next slide, please. So we've said all along when we first started this that the two most important aspects of being successful in a potash development story is, number one, capital cost reduction. So you must be low capital cost. And this feasibility study has really confirmed that Khemisset is among the lowest capital cost projects, potash projects in the world today. Capital intensity of $478 per tonne for the potash project is much less than half of the capital intensity of our peer group that are looking to develop potash mines. That really plays through in a number of ways. primarily in the ability of to be able to finance these projects using some debt. So we're very happy to be right down the bottom, 2 or 3 projects globally. That really helps us both in terms of getting that financing up, but also means we can do a much smaller project relative to our peers, which it reduces the total amount of absolute capital cost as well. The next slide, please. These are some highlights from the feasibility study. As we said, absolutely exceptional economics, a post-tax NPV8 of a bit over of around $1.4 billion US, an IRR of 38.5%, post-tax cash flow on average over the life of mine of a bit over $230 million per annum. These numbers are absolutely exceptional in every sense of the word, and you'd be very hard pressed to find not just a potash project that could have these sorts of metrics, but a mining project as well. And next slide, please. So in summary, we're now right through one of the biggest de-risking milestones for us as a company. We still have £1.2 million in the bank, which allows us to execute on those final pieces of the puzzle, which is really around environmental social impact assessment and permitting. And we're really well positioned to take this project to the next phase, which is getting it permitted, obviously, but then the financing discussions and eventually into construction and production at some point down the track. And with that, I hand back to Ben.
Excellent. Well, thank you very much for that, Hayden. So just to remind viewers who are watching this, we have received quite a few questions in advance from shareholders. There was a very strong response to the announcement that you put out last Friday. But if anybody would like to ask any questions live during this event, please just enter them in on Twitter or via Facebook. Those will come through to our moderator, and we'll be able to put those questions directly to Hayden. So Hayden, to begin with, before we start talking about Khemisset, the project, and the findings from your recent study, can we talk a little bit about the potash market and how that's structured, just to give, well, I suppose, existing shareholders and new potential shareholders just a feel for the market that you're operating in. Now, we've received one question in advance in relation to that. It says in the feasibility study, the potash price that was used was $412 a ton. So could you talk us through the thinking of using this figure and just give us an idea of how that compares to current pricing?
Yeah, it's really very simple. We use the exact same price assumption that we used in the scoping study. And the reason we did that is the key thing for a very long life project like this is not what the potash price assumption is. We run sensitivities so that you can see what happens in the downside and the upside case scenario, but really a comparison of apples to apples on a pricing assumption between the scoping study and the feasibility study. So that's the reason for using that $412 a tonne over the life of the mine. In terms of the price as today, obviously, like all commodities, it's been impacted by the coronavirus. Prior to that, it was being impacted by the trade wars between Trump and China. It really, though, depends on which market you're looking at. And so there is quite a lot of subtlety in the potash market. A lot of people will see a headline number of $220 a tonne, which is the price negotiated between potash producers and the Chinese off-takers. Importantly, we do not intend to sell any product at all to China. Our target markets are the Northwest European market, the Moroccan market, obviously, the Brazilian market, and the US market. All of those markets have a substantially higher price than what you would see in the on a contract basis in the Chinese market today. So, for instance, the Northwest European price today is about $280 a tonne delivered to the Northwest European market. Now, obviously, that's quite a lot lower than $412 a tonne, and we absolutely accept that. But we ran sensitivities down to significantly below where that price is today. And as you see in our feasibility study, it still yields a nearly 15% IRR in the downside case. I think that's an absolutely outstanding case and really reflects the robustness of this project.
So with the current prices for potash, where they are at the moment, if you look at some of the charts, so for example, I know a lot of private investors will use something like Y charts, for example. So you've obviously given us an explanation for the discrepancy between the Y charts price and then local or regional local prices. One question that's been asked to us by a shareholder is, when you do come to sell your potash on the market, what kind of prices might you expect if you were to look at today's pricing? You've obviously given us an idea for Europe, but in Brazil, for example, how much might you be looking at per tonne there?
So the contracted prices in Brazil are ranging between $240 and $275 a tonne as of today. Spot price is probably a bit below that as of today. So, it's ranging between $240 and $280 a tonne into all of our target markets, including Brazil.
Excellent. And then when it comes to the future outlook for potash, again, using Y charts as my sort of frame of reference, you can see obviously that potash is trading towards the lower end of its range at the moment, and you'd imagine that would be seen across the board. What's your outlook for potash in the future?
Yeah, well, absolutely. Like virtually all commodities, potash does show some levels of cyclicality, and right now we are at a low point in our cyclical price movements for the potash market. There's no doubt about that. Long term, we obviously expect we're relatively bullish on the potash market, as a fundamental driver of that is agricultural demand driven by food security and the need to produce more food to feed the growing population in the world. So in the long term, the general thematic for potash is very, very good. In the short to medium term, we expect the potash price in our markets, so Brazil and the European markets and Morocco, to range between, call it $300 a tonne on the low side. Every now and then it might go below that, like what we have now, which is an exceptional circumstance, and up to a high side of about $400 a tonne, $450 a tonne. So we're going to trade, we think, in that range across the life of this project over 20 years. And we may see some periods of time where the price is higher than that, and we may see some periods of time where the price is below that. But what's important for a project of this scale and the length of project life is not what happens on a day-to-day basis with the potash price, but rather in the downside scenario, is there any risk that you lose your company because you default on your debt? And we can safely say that based on the numbers for this project, there's a very, very low probability of that happening because it's just so robust in terms of cash generation at the low price. And then in the upside, of course, we make a huge amount of money, and all of our investors will be very happy with that. But we're looking more, how does this perform through the cycle? Will we be forced at any time to turn off supply in order to manage our financial position? And the answer, based on the feasibility study, is no. We should be able to produce at full pace through the cycle.
Yeah, so we've been asked a number of questions about financing and how the company will fund the project. But one word that I've just picked up on that you mentioned there, you talked about the scale of the project. Now, one question that was submitted by a shareholder in advance is, he wanted to know, when will the socio-economic impact study be complete, which could confirm Khemisset as a project of national significance in Morocco?
Well, Khemisset's already been confirmed as a project of national significance by the Mines Minister of Morocco. So we already have that label in Morocco, and we're already recognised. Really, the socio-economic study we're doing as part of our environmental social impact assessment, just to show the country of Morocco just how beneficial this project is going to be. We know that it's always helpful to have stakeholder buy-in when you're going through the various phases that we're about to go through. So it's really part of that. It's pretty well done, and so we've now got to take that away and review it and make sure that we understand the results. And then once we have done that, we will release something to the market, letting everybody know, just what positive benefits this is going to have from an economic standpoint on the region where the mine will be located.
Yeah, of course. And again, communicating to the market the positive economic benefits of the project is one thing, but of course, perhaps your bigger job arguably is to communicate that to potential financiers. Now, we've, as I say, we've received a lot of questions about funding, so we'll go into this sort of in quite a lot of detail. But to begin with, I'll ask just one of the more direct questions we received, which is, assuming that all the permits, etc., will be successfully attained leading up to construction of the mine, how will the board of directors plan to raise the money necessary to develop Khemisset, and approximately how much do you expect to need?
So the project itself is obviously about $410 million. If you add a little bit for working capital on top of that, you're probably looking to fund somewhere around the $440, $450 million range. There are a lot of potential ways to finance mines, and I think a lot of them are driven by where you are in the period of the market cycle that you're trying to finance. So at sometimes traditional equity from institutional investors is easily available and you raise money in the traditional route. At other times, which I would argue is what we're in right now, which is unusual, you need to start looking further afield, and you need to start looking at alternative options as to how you raise the funds. At this point in time, we don't have any preconceived ideas about how the project will be financed, other than to say we are running concurrently a variety of processes with people and groups that have the capacity to finance a significant proportion of this project. And we intend to continue to do that until we find an outcome or a path which is most beneficial for our current shareholders.
So a question that's come in from Richard while we've been speaking. Richard's just asked us a bit about time frame. So in broad terms, how long do you think it might take you to secure the funding that you need to take Khemisset forward?
It was very difficult to put a timeline on things like that, but I'd say from my personal objective, what I am aiming for me personally, is I would like to be coming into the first quarter of next year to be in a position to say that we are financed or largely financed, and we are permitted, and therefore we're ready to go into detailed design and engineering to take this project to being shovel ready. Now that's a fairly aggressive timeline. I think about 9 months from now. But I like to set myself relatively aggressive objectives, and I'll be working very hard to try and achieve that.
Excellent. So we're obviously just looking at a map here of where Khemisset is based. Now, one of the things I picked up on was that at the moment, I believe the project's about 200 kilometres away from the nearest port, but there's plans to open a new port on I think it's the west coast of Morocco. Could you just give us an idea whereabouts that will be roughly?
Yeah, you see it's actually labelled on there, Khemisset, which is the port directly sort of to the northwest of the POTASH project. It's about 90 kilometres from the project site. The port of Khemisset Atlantique is actually supposedly in construction. We visited the site and we've heard their timelines, and given we're trying to pursue a much more aggressive development timeline, for now, Casablanca is a better choice for us. It's already got all the infrastructure in place, and we know that we'll be able to ship our product relatively easily out of Casablanca. But in the future, we believe Khemisset will definitely become a port option for us, and that'll just save us a certain amount of money, probably $7 a tonne-ish, of that sort of region in terms of cost savings delivering it to our export port. So it's a potential upside for us in the future, but not one that we're banking on at this stage in the project's development.
Understood. So when it comes then to securing the finance that you need, obviously you need to be able to demonstrate the project's long-term viability. One of the questions that was put to us again in advance was that in June 2019, Emmerson apparently received a formal indication of significant debt financing for Khemisset from a major European commercial bank. One shareholder would like to know, is that deal still on the table?
Well, we need to go back and refresh their credit approval. So we need to go back and refresh that based on the new study. They don't have access to that yet, but part of the next phase of work that we will do will be sharing with them the feasibility study, sharing with them the new updated financial model. But considering that the project improved from the scoping study in terms of our understanding of it, but the capital costs went down, and in general the operating costs were pretty much in line. We would expect that will still be there, assuming that nothing massive has changed for those banks internally. But we haven't yet approached them. But there are a number of other potential debt financing groups that we will be engaging with over the coming months, who have the capability to finance that sort of number, which is $230 to $250 million worth of debt. So we think there are a number of groups, and we'll be speaking to them all concurrently.
So I think you've already begun to answer this, and let's keep this slide up for the moment because this is a good overview of the project's highlights. But with the results from the feasibility study, could you perhaps maybe just talk us through how or the impact that now that we actually have the numbers in front of us and you can go and present those to potential lenders, what kind of impact are you expecting to see from the results of the study?
Well, we've been in pretty regular contact with the same sort of groups, so it's not like there's going to be any new surprises coming out of this study and this announcement. We've had ongoing meetings with them, updating them on where we are in the project, and they've reaffirmed that we are a top priority for them, especially in the industrial mineral space. So, I don't think it's not going to be earth-shattering, and actually that's a good thing because it means that our scoping study hasn't gotten materially worse, and therefore. Banking syndicates, they tend to like things that are a bit boring and that there are no surprises. And I think that's what this feasibility study delivers.
And of course, one of the things you were able to demonstrate, I think, was a $19 million cost save or $19 million improvement with some of the numbers that you were looking at. I think it was a reduction in capex spend, if I remember that correctly.
Correct.
Yeah, so I guess it's sort of in the context of keeping things nice and dull for the bankers. You know, there haven't been any nasty surprises, but there has actually been some additional upside that has come through as a result of the work that you've done.
Exactly right. So this is sort of the type of feasibility study that bankers like to see. One where there are some improvements. They're not ridiculously large improvements, which means we didn't miss-scope the scoping study. And equally, there are no massive downside surprises, which means that we were completely wrong in the first instance.
So we'll stick with the financing for the time being. I've got a couple of questions about the MOU to put to you in a minute. But another question received in advance. It says, Hayden Locke said in the Mining Journal interview that capex could be reduced to $200 million for a smaller project. How would this be achieved?
Well, so the way we would approach that, and I think it's probably more like $250 million, if we were to do a half-size project, so rather than producing 750 to 800,000 tonnes a year, we would produce 375 to call it 400,000 tonnes a year. The obvious savings are significant reduction in underground equipment usage, significant reduction in underground conveyor belts, lighting, all of that sort of stuff. We would save no money on the decline, obviously, but then a quite significant reduction in the processing plant cost because it is relatively modular. We just have one less train and then a smaller footprint, all of those sorts of things, knock-on benefits. So it's not quite, you don't quite divide it by half because you do get economies of scale of doing the larger project. But, you know, as a rough rule of thumb, we think that we could get that down to around $250 million on the pre-production front by doing a phased approach, 400,000 tonnes to start and ramping up to 800,000 tonnes over the life of mine. That's not really a preference. So the first port of call for us is really go out to all of these strategic groups, potential financing groups that we have been having lots of conversations with over the past 2 years and test the appetite for the full project and see whether or not there is appetite to support us with that full project development. And then, you know, once we get to the end of that, we can reassess how we go about developing this. There are a multitude of ways for us to develop this project in a reduced fashion that reduces the upfront capex. But as it currently stands, we really want to test the market to see whether or not there is appetite for the full project.
So, talking about appetite for the project and multiple ways of potentially developing it, another question put to us by a shareholder is, are there any other creative financing sources that you might be able to tap? For example, selling a royalty in the project. What other options are open to the company?
Yeah, there are. Well, I mean, the royalty is the most obvious one given where our market cap is because, you know, a royalty, although people claim that it's not dilutionary, is actually dilutionary at the bottom line in every sense of the word, except that we're not selling new shares. And when your share price and your valuation is as depressed relative to the intrinsic value and the potential cash flows of the project as ours is, it starts to make a lot of sense for our current shareholders to go and do a significant royalty. And there are a number of groups who have the capability and the desire to write very big royalty checks for industrial mineral projects. It makes a lot of sense because royalty companies love long-lived projects, things with resource upside that they're not necessarily pricing in on day one, which this project obviously has. They like things that will continue to produce through the commodity cycle, regardless of the price of the commodity that they're looking at, which this project will obviously be able to do, given that it's bottom quartile cash costs. So, yeah, there are a number of different ways that we could potentially finance this, and we are talking to all groups. And then at the end of the day, mathematically, one of them will provide us the best economic outcome. Then we'll look at the soft issues, more qualitative issues. How does that impact our ability to operate the company? How does that impact us in a potential downside scenario? All of that needs to be factored into the decision-making process before we decide which avenue we will take.
Of course, Ben, now that you're armed, obviously, with the results of your new feasibility study, you're actually in a in a good position to be able to go out and explore those different options, with obviously armed with the facts, and hopefully maybe introduce a bit of buying pressure in there as well, and play some parties off against one another to strengthen your negotiating position. Now, in the context,
feasibility study, exactly right. The feasibility study is the catalyst for all of those discussions to become real, and so we've got a number of groups waiting to receive the feasibility study as soon as we've gone through and made sure that it's all well ordered and well organised.
Yeah, of course. And obviously, you've talked a bit about the longevity of the project. Now, one of the questions, again, put in advance, was there was an MOU, a Memorandum of Understanding, easy for me to say, offtake agreement signed in April 2019, which was for 100% of all potash produced over a five-year period, with an option to become binding in September last year. So one shareholder would like to know why didn't that MOU ever crystallise into a binding agreement?
There's a variety of reasons, but probably the most obvious is we started having some discussions with potential strategic groups about investments in the company and in the project, and those investments would require us to be able to give pro rata offtake, and we would value very highly, obviously, an offtaker coming in and investing in the project. That's one of our potential methods to finance this mine. So we made the decision that we wanted to keep our offtake free at this point in time. That group is still available to us, but we think that they're less likely to invest in the project. And so until we understand exactly what the market looks like and whether there are strategic groups that would like to invest to obtain life of mine offtake, we're going to keep that open and available as a fairly key asset and negotiating point for our future discussions.
And are you able to quantify how much interest there might be from other potential off-takers? Is a discussion you must be sort of ongoing at the moment?
Yeah, we've been speaking to a lot of groups for a long period of time. I can't really say any more than that, but there are plenty of groups with interest in this. I think the way to answer that is really, in the potash market is an oligopoly structure where there are a total of 10 producers that sell potash globally, of which 3 or 4 control about 70% of the market. And that is very problematic for the vast majority of fertiliser industry players who are price takers in every sense of the word from these potash producers. And so every single participant in the fertiliser industry would love to have an alternative source of potash production available to them. And what we're saying to them is, well, if you want to secure your source of potash through us at a market price, we would expect an investment in the project to help us get it into production.
So we're looking now at the slide that that compares Khemisset's capital intensity to other projects around the world. Can you just talk us a bit more detail through this slide, and why Khemisset is a significant project in a global context?
Yeah, why is it so much lower in capital intensity, I think, is the key question, and really it comes down to two things. So I always start by saying we don't save any money on the underground mine itself. This is the same mine as operates in Canada. It's the same mine that operates in Spain, in Russia, in Belarus. All of those mines are underground conventional. Virtually all of them are underground conventional mines using continuous miners to produce ore that goes to the surface. We also don't save any money on the processing side of it. So where we take the ore and concentrate it to get to that final K60 product, we don't save any money there. The two areas where we save money are, number one, access to mineralization. So we don't have to build a shaft. We don't have to do any ground freezing. And against a typical Canadian peer, we save about $1 billion on that item alone. So that's a $1 billion cost saving. It's not a mistake. It is actually $1 billion. And then on the other side, we have huge cost savings on the infrastructure. So potash is a bulk commodity. Transport and logistics is incredibly important. The further you are from your port, the more costly it is to put in the infrastructure to transport your product from your site to your port. If you don't have access to power lines, you have to build them. They are expensive when you start to talk hundreds of kilometres of power lines, roads upgrading, all of those things, gas, everything that is required to run a mine. The more remote location and the worse the infrastructure, the more costly it is on the back end. And we estimate we save, against the typical Canadian peer, about $500 million on the infrastructure. So infrastructure is electricity, roads, rail, ports. Very importantly, we don't have to spend any money on a port. And that's really what sets Khemisset apart from just about every other project in the world, with the exception of the Spanish assets.
Right, I see. So, I mean, so when it obviously we talked about sort of funding partners and the interest that there'll be. You've obviously just described there, how this project, it really can be, given its particularly its access to seaports and therefore access to global markets. There really is a genuine shot here at seeing this, what's still a relatively small AIM company actually delivering on a project of international significance.
Yeah, I think the benefit of having very low capital cost and competitive operating costs is we are infinitely more financeable at every single size than just about every peer. And so, if we have to reduce the upfront capex in order to get it financed, that's what we'll do. But in the first instance, I think that there should be enough interest in the large project for us to retain what we think is the sweet spot in terms of development size for the time being. And then once we've assessed the interest at that level, if there isn't any, then we'll start to think about how we can get creative in terms of developing this project and really reducing that upfront capital cost. And there are a multitude of ways that we could potentially do that.
Now, I mean, obviously what you're touching on there or alluding to is how complex these sorts of negotiations can be. Of course, we don't live in a very patient market, and gaps in news flow can often lead to, punishment of share prices. So one question shareholders put to us in advance is what kind of news flow might we expect from Emmerson over, let's say, the second half of 2020 to keep the narrative alive, to keep interest in the stock while these negotiations are ongoing?
Yeah, well, there are a couple of different aspects that you're absolutely right. They move at different paces, and so probably the slowest of those will be the equity discussions. So we're talking any big financing partners. That will probably be the slowest portion of the discussions, just because they tend to be the slowest in terms of getting people over the line, and there's more parties involved. In parallel to that, we will be doing all of the permitting. So we're talking the ESIA will be complete towards the end of the year, and we'll be aiming to be fully permitted by the first quarter of next year. Obviously there may be some impacts as a result of the lockdown that's occurring right now, but we're yet to understand fully how much that's going to impact our timelines. So permitting is going to be a big part of this story. And then the debt financing discussions, that'll move quite a lot faster than the equity discussions. It'll still be a relatively time-consuming process, but we expect to be able to give some updates on what we're seeing from that side of the market as we move gradually towards getting ourselves in a position to have a credit-approved term sheet for debt finance for the project. We'll also have the other non-traditional financing discussions. Then we go into the project itself. We're not completely done. We also have the SOP project, which is a sulfate of potash project. We put out a scoping study on that last year. That is a very, very interesting project for us, and we intend to take that to the next level of study. So in taking that through to a PFS standard. That actually plays into a potential slightly different development strategy that we might look at further down the track, depending on the financing that's available. But it really adds quite a lot of strategic value to this story. And then we're also having a very detailed look at the salt market. We do actually produce nearly 4 times as much salt as we have included in the business plan for the feasibility study. So there is a very clear opportunity for us to upscale on the salt with ongoing work there, and we're in touch with a couple of salt market participants, trading companies that would be willing to move our product for us. So we're having some interesting discussions on that front, and then really starting to get ready for the build. So building a team that has the capability to construct and operate a potash mine in Morocco. We're going to start announcing, hopefully, that we're going to be bringing people on board as part of that team, and then moving into that next phase of engineering work and all of the things that come out of that. So there'll be lots of land acquisition, for instance, stakeholder engagement. There's going to be a huge amount of work going on the ground, which in and of itself may not be as exciting to the market, but really shows that the momentum forwards is continuing.
And will be the sort of things that funders will obviously want to see to show that obviously the project is in progress, it is developing and being de-risked, as each month goes by.
Absolutely.
So we'll talk a little bit about the salt project in a moment, because we've had a number of questions about that. But before we move on to that, we've received a question asking about the relationship with OCP. So the question's been put: with the split ownership of the Potash Basin between Emmerson and OCP, it would suggest that a partnership could be an option at some stage. Is this an alternative for the business? Is there might there be a partnership with OCP at some stage in the future?
Well, it's difficult to say whether or not there will be or won't be, but other than to say that we know OCP very well, and we've had a lot of contact with them over the last 2 years. They have a clear need for potash. They do own part of the basin. We think that their portion of the basin would be better in our hands, and so we may look at trying to acquire that from them at some point. Would we entertain the idea of having them as our development partner? Of course. They're one of the biggest fertiliser companies in the world. They're also one of the biggest single consumers of potash in the world. It would make a lot of sense for them to partner with a group like us, other than to say I think they would probably prefer to own the whole thing themselves.
So moving our attention then back to the salt project, you give us a brief overview of what your plans are there, but just to ask a bit more definitively, do you plan to move this project through to a full definitive feasibility study?
Well, the feasibility study that we've delivered is bankable in every sense of the word from my perspective. So there's no further work that is required from this feasibility study from our perspective. We will need to do additional work in the lead up to detailed design and engineering, but no, there's no need to do any more work before we take this to financing institutions.
So the old salt mine at Khemisset, apparently, according to one of your shareholders, had a 3,000 million ton deposit with 99% pure sodium chloride. In the 1970s, this was used as apparently as an industrial chemicals and manufacturing site. Does this mine belong to Emmerson, and can any value be extracted from it?
We do own an old salt mine, a mine that produced mostly de-icing quality salt in the mid 2000, sort of 2010 to 2015 range. We still have an open decline on the site. We still have the capability to go down to those mining horizons if we choose to. From my experience, the economics on that salt mine are probably going to be a little bit challenging for us to make money, and it would distract us from what is the main game, which is the potash development project as it currently stands. It's not to say that we won't come back to it at a later date once we're in production and we've got cash flow to examine just what the potential of that project might be. But as it currently stands, we're very much focused on the potash and the byproduct that will be produced from that, which is de-icing salt only.
Right, so if we just bring up the location map, which is slide 2, the question put to us that the SOP project is located apparently at the port of Djorf Far, which we can see, well, just to the south of Casablanca. Is that correct?
Yeah, that's correct.
So apparently previously this supplied so it was used where OCP has their main manufacturing plant and sulfuric acid plant there. Have you been in discussions with OCP about supplying sulfuric acid needed for your project?
Yes, we have. So our in-country senior management has had a lot of discussions with OCP and the various managers of the OCP industrial complex. Part of that was really identifying a potential site for us to put the SOP project. So yes, there have been discussions. None of them have been formalised, but we do know, obviously, that OCP has one of the world's biggest sulphur burners making sulfuric acid for their industrial processes making phosphoric acid. So there's certainly capacity available, and there's some very well-located sites in the OCP industrial complex that would be perfect for an SOP project like ours to be built. Really co-locating with acid and with the potential to dispose of hydrochloric acid is fundamental in making that project competitive and much more cost effective than all of the Mannheim producing peers that we've looked at. So yeah, we've had a few early stage conversations. I would say the next phase of development will require us to have much more meaningful conversations with those groups.
Absolutely. Now, are you able to quantify at all what the sale of hydrochloric acid might mean for Emmerson? Are you able to give us any sort of numbers to paint a picture?
Hydrochloric acid is very difficult to dispose of, and so we wouldn't consider selling hydrochloric acid. That's probably one of the biggest hamstrings on any new Mannheim development project, is what do you do with your hydrochloric acid waste product that comes out of the process of turning MOP into SOP. You can sell it into the oil and gas industry. It can be used for steel pickling, but typically the market is quite small, and the transportation costs for any sort of acid, but hydrochloric acid in particular, is very, very costly. So if you're a long way away from somebody whose end use it is, selling hydrochloric in its purest form is very difficult to do. What we would envisage doing is, chemistry 101, react hydrochloric acid with limestone. And I'm sure everyone's done that test in chemistry lab where you put a bit of hydrochloric acid on limestone and watch it bubble and create heat. It turns into water, carbon dioxide, and another salt called calcium chloride. Calcium chloride is another additional salt product, but can also be stored on surface because it doesn't have the same handling requirements that hydrochloric acid has. So you can create a high-value de-icing salt product from that hydrochloric acid, and that's what we would intend to do. And there are a number of limestone quarries within close proximity to the Jorflas facility that would be able to supply us with the limestone in order to achieve that.
Right. So moving over to a new topic. Richard again has asked us another question while we've been live. Richard wants to know: is there a chance of a buyout of EMLA before the project gets financed?
Well, there's always a chance. Do I think it's a chance that it'll occur in the near future? No, and that's the reason why I've always said that regardless of what happens, my intention is always to build a team that can build and operate this potash mine, to do all of the work in the feasibility study to a level required to get this financed and taken into construction and production. I do think that there is a very strong chance of us finding a partner who would like to develop this alongside of us. But I wouldn't necessarily think at today's prices that our shareholders would be wanting to sell when I've been saying that the big carrot and the big upside is getting a project like this into production. If you get a potash mine into production and you're outside of the cartel of potash producers, the asset becomes extremely strategically valuable. And we're not talking NPV valuations then, we're talking multiples of EBITDA that are well north of what you would see for a traditional mining project. So for me, and for the management team, it's really the number one option is to take this into production and become an independent, out of the cartel potash producer, which would make this just another level of strategically valuable asset.
Yeah, absolutely. I understand that. But of course, I mean, one area that we haven't talked about yet so far is you have your primary vision, how you want to develop the company. You've just given us that very, very clearly. But is there any chance you see Emmerson as a potential takeover target? Let's say one of the cartel members, this takes a real interest in taking this project forward themselves.
Of course, yeah, absolutely. And not just from the cartel members themselves, not from the oligopoly potash producers, but from any fertilizer industry player who has a need to own or buy potash as a raw material to go into their manufacturing processes. This project would be incredibly strategically valuable. So to give you an example of the strategic value of a project like this, if you think about what are the three key macronutrients used in fertilizer production. It's nitrogen, phosphorus, and potassium. So nitrogen is a function of how cheap your gas is. So as a result, anywhere in the Gulf states, so Saudi Arabia, Qatar, Oman, Abu Dhabi, any of those sorts of places with plentiful gas, typically have a very large nitrogen fertilizer industry. So they produce a lot of nitrogen-based fertilizers. That's great, but you're selling a commodity at that point. The real way to make money in fertilizer is to create multi-nutrient fertilizers bespoke for very large customers. So you need to take a little bit of nitrogen, a little bit of phosphorus, a little bit of potassium, maybe some micronutrients like boron, and you create this bespoke multi-nutrient fertilizer, and that achieves a premium price over the commodities that are going into it. But if you look at it from the perspective of the Gulf state fertilizer producers, They own a very good source of nitrogen. Often they have good sources of phosphorus. They typically have very good relationships with Morocco, who are a huge source of phosphate. But the one area that they don't have any control over is potash. And the only people that they can buy the potash from to go into that raw material as a raw material into that manufacturing process are their direct competitors in the end market of multi-nutrient fertilizers. So they never get a good deal. They get absolutely screwed on the price of their potash. They rarely get consistent supply. And so for groups like that, owning a source of potash is just a huge strategic leap for them to make them much more competitive in a global sense in the global multi-nutrient fertilizer industry. So yes, there is absolutely a chance that this gets taken out. But I think we've got to realise that most of these groups are not mining groups. So they would like to see construction moving us into that, taking it into production. And actually, that is where we as shareholders are going to make the best return on our investment.
Well, that then brings us, I suppose, to talk about the best return for you as shareholders, and of course, as for your other shareholders as well. To talk a bit about the company's share price. Now, we talked a bit about this before the interview, and how the stock had traded. Your view that you see the company trading at discount to its fair value, certainly after the numbers that you've been able to release recently. So, are you able to give us what can you tell us about your view on the company's share price and the value within that?
I typically don't go out to tell people what to think about the share price. Probably the easiest way for me to answer that is just to point at what our analysts are saying. So Phil Swinfen, one of the best analysts in the City of London, has a value price target on us of 17p. So well north of where we are today. Align Research north of 20p. I think regardless of which of those you look at, today's share price at 5, we're trading at a significant discount, even if you want to take a 50% haircut on those numbers. For me, I can't control the share price, so I typically try not to look at it. I often fail miserably to do that because it is important, but I'll just keep my head down, keep moving the project forward. And perversely, having a low share price is actually encourages and an incentive for strategic partners to look at this because they feel like they're getting a very good deal. I have been involved in other projects where we had a valuation which was reflective of the project, and it made it very hard to get a deal done because the groups coming in didn't feel like they were getting a good deal. So actually it might help us, which is a bit of an irony.
Excellent. Well, let's talk to wrap things up now. I'm conscious that you obviously have your family to get back to, so thank you for your time this evening. But to wrap things up, let's talk a bit about the company's financing. Now, in the announcement released last week, as you just confirmed, the company had a cash balance of £1.2 million at the end of April. You've talked about some of your plans for permitting and looking to scale up the company, bringing in new expertise. How much runway does that £1.2 million give you?
Well, it depends on what we work on, but if we just assume that we're only going to do the permitting and run our overheads in the background, it'll last us until the end of next year. We have a very, very low burn rate. We don't spend much as a company. I'm the only person in London, very small office. So we run a very, very lean team, lots of people wearing different hats. If we want to go in, so that money will last us as long as we need it to. But if we see, for instance, that the permits are going to come when we think they are and we want to start getting into the detailed design and engineering, we could potentially use a little bit more money. We're not going to need $50 million to start with, to really take this into getting the project shovel ready. We probably need about $10 million.
Excellent. Well, look, Hayden, thank you very much for your time this evening. It's been very good to talk to you. You've had a number of quite tough questions there from shareholders, all of which you've answered. So I'm sure they appreciate that. Just to let everybody know, we'll be publishing a copy of this webinar tomorrow on the website, so it'll be available for anybody who wasn't able to join us. So it leaves me to bring this to an end and say, Hayden, thank you very much for your time.
Thanks very much, Ben. Great to be on it. It's a fantastic platform.
Thank you.